What would you do if someone told you that your investment portfolio is at risk of losing most of its value due to an imminent recession? Would you cry, pray, sell everything? Or maybe would you try to figure out how to protect your savings and maybe even take advantage of the situation? If you're among those who want to know how to rebalance your portfolio in view of a recession in the US, then this video is for you. In this video, I will explain what a recession means, what are the signs that announce it, how different asset classes have performed during past recession phases, and what are the most effective strategies to deal with this scenario. But before we start, I remind you to subscribe to my channel and activate the bell so you don't miss my next videos. Also, I invite you to leave a comment with your opinion. And now, let's begin. What is a recession? A recession is a period of contraction of economic activity characterized by a decrease in production, income, employment, and trade. Usually, we talk about recession when real gross domestic product, GDP, decreases for 2 consecutive quarters or more. However, there are also other definitions based on economic cycle or specific indicators. The causes of a recession can be multiple: external shocks, financial crisis, macroeconomic imbalances, restrictive monetary or fiscal policies, etc. The consequences of a recession can be serious: increase in unemployment, poverty, public and private debt, reduction of consumer and investor confidence, etc. Recessions are cyclical phenomena that occur with a certain frequency in economic history. In the last 100 years, the U.S. has gone through 15 recessions officially dated by the National Bureau of Economic Research, NBER, the last of which was caused by COVID-19 pandemic in 2020. What are the signs that announce a recession? Predicting precisely the beginning and the end of a recession is very difficult, if not impossible. However, there are some indicators that can help identify trends and probabilities of a recession. One of the most followed indicators is the inversion of the yield curve of the U.S. Treasury securities. We could talk about inversion with the yield of short-term securities, for example 2 years, exceeding that of long-term securities, for example 10 years. This means that investors expect interest rates to fall in the future due to a weakness of the economy. The inversion of the yield curve has preceded all the last 7 recessions in the U.S. Another indicator is the ISM Index, Institute for Supply Management, that measures the activity of the manufacturing sector in the U.S. A value below 50 indicates a contraction of the sector, while a value above indicates an expansion. The ISM Index has shown a strong correlation with the economic cycle and has anticipated the last 4 recessions in the U.S. A value below 42 indicates a high probability of recession. A third indicator is the level of consumer confidence, which reflects the expectations and spending intentions of households. A drop in consumer confidence can have a negative effect on domestic demand and GDP. Consumer confidence has fallen sharply in recent months, reaching its lowest level since 2016. How to rebalance your portfolio in view of a recession? If we are convinced that a recession is around the corner, how should we behave with our investments? Which are the most suitable asset classes to protect our capital and generate positive returns? In general, the most recommended asset classes during a recession are those that offer greater security and stability, such as government bonds, high-quality corporate bonds, short-term debt, and the US dollar. These asset classes tend to benefit from the reduction of interest rates by the Fed and the increased demand for refuge by investors. On the contrary, the most risky and sensitive asset classes to the economic cycle, such as stocks, commodities, and emerging currencies, tend to suffer during a recession. These asset classes suffer from the drop of global demand, earnings growth, and investor confidence. However, not all stocks behave the same way during a recession. Some sectors are more defensive than others and can offer interesting investment opportunities. Among these are essential consumer goods, healthcare, utilities, and technology. These sectors offer products or services that are less affected by the economic situation and that can benefit from positive structural trends. Moreover, it is important not to lose sight of the time horizon of your investments. If you have a long-term perspective, you can take advantage of the recession phase to buy stocks at discounted prices and benefit from the subsequent market recovery. The important thing is to have a clear and diversified strategy that takes into account your risk profile and your financial goals. Also remember that trying to predict the beginning and end of a recession is very difficult and that markets can anticipate or delay changes in real economy. So don't get carried away by panic or euphoria and always follow the principles of smart investing. This video does not want to be a financial advice, but only a general information. Before investing, always consult a qualified professional. We hope this video has been useful for you to understand how to rebalance your portfolio in view of a recession in the US. If you liked it, leave a like and subscribe to my channel so you don't miss my next videos. Thank you for your attention and see you next time.